my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola and Malaysian palm oil markets. I'll start with Paris rapeseed. Last week, as many of you know, I was at the Commodity Trading Week online conference, so it was nice to come back here and see some interesting patterns clarified, ones which I had pointed out earlier. Okay, let's remove the clutter that's there before we cut to the chase. The late April to May bullish Andrews pitchfork, a speculative idea at best, is now retired. So 2 weeks ago, actually I said this 2 weeks ago, but it refers to an idea I had about 3 weeks ago. So here goes, and I quote, "I'd like to reprise something I spoke about last week that fits in with the recent moves higher and the current hesitation." I quote, "There is another thing related to this that I'd like to discuss. This is way too early, but perhaps, just perhaps, we may have the makings of a possible head and shoulders pattern emerging from mid-April to date, and using the bottom of the two hammers as the neckline, currently at 491.5, that's today. This is just a speculative thought right now, but if the market were to somehow turn around back down before reaching the highs in the 540s, then it might be a valid idea. I just wanted to make it known here rather than just let it rattle around in my mind alone." And that's the end of the quote. This was one of two possible scenarios, but it seems to be the one that fits. What is interesting has been the action since last week. You see, on Monday and Tuesday last week, we had an island top, the second within 2 months. And if this head and shoulders idea proves true, then both the head and the right shoulder would be island tops. Anyway, the key move lower happened this past Monday with a gapping lower move, since filled in, as the market tackled the first significant moving average, short medium moving average, currently at 503.80. Yesterday saw a more significant gap as the market opened below this moving average and halted at the neckline of the head and shoulders top. Today we've gapped a third time, or is it a second time if you don't count that filled-in gap? That could be actually quite important information soon. Anyway, we gapped lower today, below the neckline, punching down through the late February to date uptrend, currently at 478.5, very much as if it wasn't there, and only halting when tangling with the congestion made of the recent 50% Fibonacci line at 471.25 and the rising medium moving average, currently 470 even. Additionally, just below we have some Fibonacci congestion at 467.5, 466 even, and a 2013 higher at 464.25. This is why we have ended up where we have today. Interestingly, the next real support will be the March to April congestion between 456.5 to 436.5, which houses highs from March, April and June 2013, as well as the gently rising long moving average, currently at 436.5. Okay, now it is time to talk about head and shoulders top and what it may have in store below. Target X in the 458.25 area is a provisional target and looking eminently doable. A full and traditional target X1 is in the 426.5 area, which is quite a way down and below the long moving average as well. Winnipeg canola. 3 weeks ago, I spoke about 3 interesting things seen here on this chart since the fall in early May. I want now to concentrate on the last of these 3, and I quote, "Finally, my third point. This related to the action this week, which is actually now 3 weeks ago. We have seen 2 indecisive patterns already and probably a third on the way today, with a possible bullish hammer action as well. It is all indicative of indecision at these levels. There is some congestion here between 702.70 and 729.10, though we do have the overhead rising medium moving average, currently at 459.20, capping the action as well. However, I have a suspicion that the 2021 uptrend, currently 429 even, may have something to do with it, but not as an uptrend, but as a version of a bearish bump and run reversal pattern type, formed over 2021. It's not a clear pattern at all. I can see many arguments against it. End of quote. 2 weeks ago, I added the following, and I quote, "As you can see, the key action to look at is what the market does and may do around the 2021 uptrend, and I suppose by inference what it also does around the late October 2020 to date uptrend, currently at 730.5. End of quote. Later on in the same commentary, and I quote, "The next significant overhead resistance, the medium moving average, I'd already pointed out earlier. That this was important level overhead, and so it has proved to be, as though today we've punched up through it, the market ran into a brick wall formed from the 50% Fibonacci line of the October 2020 to May 2021 move just over it at 761 and reverted back down below the medium moving average, and that is where we are now. The question now is, will the medium moving average continue to cap this market? Because if it does, then the chances of a possible bearish bump and run reversal top just increased. You see, you would expect a little pullback and hesitation from the uptrends as part of the pattern. Watch this space." And that's the end of the quotes. Well, the medium moving average eroded a lot of the bullish incentive, but the short medium moving average just above, currently at 485.40, dealt the killer blow, capping the action on a Monday and Tuesday last week and leading us to where we are, below the two uptrends and testing the long moving average below, currently at 666.70. So what now? Well, for the bearish bump and run reversal top type pattern, well, I'll measure it conservatively, but it would suggest a target X below in the 598 even area. That is all I can say on this one so far. Bursa Malaysia crude palm oil. Finally, the mid-October 2020 to late January 2021 bullish shift pitchfork, which had shown the bullish angle of attack of this market since the start of this year, is gone, retired. As is the broken, slightly more acute bullish shift pitchfork for the January to late March move. As I stated 2 weeks ago, and I quote, "The market reached target X in the 46.75 area. This is the target from the January low base bullish halfway hesitation pattern. Then 2 weeks ago, which is actually now 4 weeks ago, prices dropped off a cliff, all the way down, hesitating for a little while." End of quote. This hesitation turned out to be a bear flag formation, the target for which we've already achieved last week, which also included within it a somewhat failed weekly key reversal up, a rare enough find. Anyway, the market made gapping moves lower, down, through the recent 50% Fibonacci line of 40.10, the flatlining medium moving average, currently 39.72, the February to date uptrend, currently 38.21. Remember this trend line, it will show up later. Down through the long moving average, currently 36.20, and finally down into a support area starting with the old September 2015 to November 2017 head and shoulders neckline, currently at 34.96. And also the August to date uptrend, currently at 34.27, and most importantly, two 50% Fibonacci lines, the 2019 to date move currently at 33.31 and the 2020 to date move currently at 33.59. I suspect these two are key. It is here that I point out something I highlighted 2 weeks ago. It deals with the June high on the 3rd of June, a bearish opening black Maribozo pattern that day that was also one of the most potent bearish patterns available, a bearish belt hold pattern. Remember that one, that's the important one. And I quote, "If the bearish belt hold takes charge and we move lower, then we would seemingly be endorsing the bearish incentive, and the medium moving average may come back into play." I'll finish with something I spoke about last week, which is actually now 3 weeks ago, which you can also add to the cooking pot. And I quote, this is from then. "My one cause of concern is that the action this week, that is 3 weeks ago, is just a halfway hesitation. If that were to be the case, then we would see the market try down to the 3600 area, close to the long moving average. At the moment, this is just a cause of concern. In the back of my mind, I'd rather say it than not and look even more foolish." End of quote. That is why I say things which may sound foolish, because they often turn out not to be so. Okay, so we're holding now, if barely. And let me add this to the mix. If, as in the other oilseeds and vegetable oils we've seen, or some of them at least, we look at the February to date action as a bearish bump and run reversal top, then that broken uptrend from February would be the trend line for this pattern. Remember the one I asked you to remember? In which case we have a target below at 33.82. Okay, what is important about this is that the target for the bearish bump and run reversal pattern has already been achieved last Monday. This is important as it is the first such target below the market for this type of pattern to be achieved in any of the markets. We now need to see if there will be a pullback up, which is something that also happens. If it does, which is still a big if it does, then the rise could be as far as the 42.50 area and yet still retain the bearish incentive. I've not marked the pullback up as it is a limit rather than a target, but it's worth watching out for. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.